welcome again. Thanks for joining me for this month's Jaco's Corner. We've got a great guest here again today to share some of his views with you of what's going on the current economical situation. I'm going to introduce Ricardo Smith to maybe just give us a quick introduction of what exactly is his role with Absa and what's his view of a few questions that I've got lined up for him today. Ricardo, thank you for making time for me today. But I think to start off, I'm going to ask you, please, maybe if you can just give a quick introduction of exactly who are you, what's your current role with Absa, to just inform the clients exactly who you are.
Thanks Jaco, and thanks for having me. Always a pleasure to engage and interact on markets. So in terms of my role at Absa, I'm the Chief Investment Officer for Absa Investments, Stockbrokers and Portfolio Management. I've been with Absa for quite some time, close to 10 years now. Previously to my current role, I was heading up the investment strategy desk at Absa Global Investments and Solutions. So really looking forward to our engagement.
The first question I've got for you today that you can maybe just give us a little bit of your view on is to say, currently in the current markets, where would you think is a good opportunity to invest into? Which asset class do you think there's opportunities in?
There's quite a few opportunities. I guess the starting point for me is always about what the objectives are of the client and the investor, whether it's wealth creation, capital preservation or income provision. But certainly there's a lot of value, firstly on fixed income securities. We've seen a lot of yield uptick and a lot of great coupon payments, diversification benefits that we are getting from fixed income. And then lower down the risk spectrum, cash rates are quite attractive for individuals who are looking for income and capital preservation, but not necessarily capital appreciation. Then on the capital appreciation side, equity markets as well, done well this year. Still a lot of value on the table, some sector rotation. We do expect a lot of short-term volatility in equity markets with a lot of the uncertainty that's happening both locally and globally. But for the long-term investor who wants wealth creation, there's quite a lot of value there too.
Ricardo, then another question that I've got for you here that comes up quite a bit the last few months is to say, South Africa's equity market has become quite small. And that means to say the buying power is quite limited for large purchases on the JSE. What's your view? Do you think that the South African market is limited currently and that limits growth potential and returns?
There is quite a lot of limitation in terms of individual stock concentration on the JSE. We have seen quite a lot of delistings as well recently that have been ongoing, which further limits the market. What is important to note though is that we've actually seen quite a lot of sector rotation within the JSE where one sector outperforms another sector. And for instance, in the last couple of years, we've seen the resource sector doing quite well, which was quite an interesting one because prior to that, it had been out of favor and a lot of the tech sector had done well. And what we're seeing this year is that we're seeing industrials actually performing quite strongly. So we have seen some sector diversification, although within the sectors and subsectors, it is not as diverse as the global universe of stocks.
What is your outlook for the JSE? Let's call it top 40 companies for the next few months.
The top 5 companies or so probably account for more than 50% of returns. So your relative positioning on those companies will be quite important to whether they outperform or underperform the market overall. But also needing some good portfolio management and risk management skills, not to overweight in those individual securities, even if you like them. From an outlook perspective, we at the moment are more defensive on the all share, looking for some of your consumer staples. We do like the rand hedged consumer staples, so some of your companies that are earning in dollars and not necessarily in rands. We think locally there is quite a lot of headwinds, particularly the energy crisis, high unemployment rates and the likes. Some of your cyclical counters have done very well in the past. We do expect earnings to come under pressure, particularly in the mining and resource sector as well as energy sector. Although industrials have been doing well recently, we do think there's some headwinds there as well. Long term, we are still expecting double-digit returns in the all share, but definitely short term there is some volatility, and we expect certain sectors to outperform, some of the other sectors that have done well recently.
Then, Ricardo, moving on to the next question, it will be to say, moving on to the international markets, what's your view on international equity markets, and what's your outlook when it comes to returns there?
So we think there's also a lot of value on the table. Coming into the year, global markets were certainly better positioned than last year after some of the pullbacks and drawdowns that we saw. We have seen some of those rallies coming in, particularly if you look at S&P 500 up close to 20% year to date in dollar terms. European markets also quite up. We do think quite a lot of the rally has aggressively priced in interest rate cuts from the US Fed. We don't necessarily see that happening this year, but we've also seen some strong positive earnings while beating consensus expectations in the US. And so we do think, yet again, there's a lot of potential for long-term returns and growth from current levels, but we are balancing the near-term risks, particularly the interest rate cycle, fears of a recession on the table over the next 12 months, although those fears seem to be subsiding as inflation, particularly in the US, has been better behaved recently.
Then a question that basically goes out every month now, to put you on the spot a little bit, Ricardo, is what is your expectations and views regarding the interest rate currently? Do you believe it will increase, stay as it is, locally and internationally? If you can just maybe give us a little bit more on your views on that, please.
So I'll just start on the global side. We saw recently the US Fed continuing to hike rates by 25 basis points. This follows their pause on their previous meeting. Locally, we did see the MPC pause rates. This is the first time in 10 consecutive hikes that they've decided to pause. We do believe that we are nearer to the top of the rate hiking cycle than the bottom. So long term, certainly expecting rates to be lower than current levels. Not expecting them to be as low as some of the pre-COVID levels that we've seen. So rates will likely be elevated relatively to what we've seen in the past, low rate environment. But the current level is unsustainable. Absa research expects that the MPC has peaked. There is a risk of one or two more rate hikes and over tightening here and there. But overall, we think that the direction for interest rates from current levels is lower than higher. And then in the US, we're certainly expecting at least one more rate hike this year. We think Europe and the UK are slightly behind, and we may see more rate hikes coming out of those regions. But certainly over the next, say, 3 to 5 years, we are expecting rates to be lower than current levels.
Ricardo, then the last question on my side for today is then just to get your views on, to say, you've just answered the question to say what your views are on interest rates. If we've got another interest rate or two hikes that will filter through the system for the next year or so, what is the impact that will most probably have on the equity market?
I think the aggressive pricing, particularly in the US, of a pause in the rate hiking cycle is a bit of a risk. But the current trajectory of interest rates, and even in the last hike that the US Fed actually implemented, markets had already priced it in because the US Fed had already indicated that they would be looking to peak at 5.75 being the upper bound. They are currently at 5.5. I think if they change their trajectory and their view of interest rates to a bit higher than at 5.75, then we would expect a bit of volatility in the markets. All asset classes, have this negative relationship with interest rates. It's more pronounced on fixed income, but it's there on equity markets as well. And in particular, some of the longer duration investments, like in the tech sector that you have. So we would expect some volatility should we get a revision of the trajectory. But having said that, the one rate hike in the US Fed is pretty much baked in by the markets. locally we're less sensitive to interest rates at this point, especially with the JSE being 60% rand hedged. I think what will drive a lot of the local companies a lot more is the stability of our state-owned enterprises. In particular, Eskom on the electricity front, and Transnet on the rail in terms of import and export of some of the mining counters.
Great. Ricardo, then thank you. I really appreciate you making time to come and share your views with us. I think it was definitely insightful and worthwhile.
Thanks, Jaco. Thanks for having me.
Thank you again for taking time to watch this video. I'll keep in touch and hopefully meet up with you guys again next month. Keep well.